There is a traditional saying, which is markets climb a wall of worry. I would say there's definitely been a wall of worry. There are a lot of people who say this has been the most hated rally ever. We're at stock markets near all-time highs, gold near all-time highs, Bitcoin near all-time highs, real estate pretty high. A lot of things are pretty high. Does that mean we're close to the top? At the same time, in a bunch of regards, you see deteriorating fundamentals. So for example, they had all these revisions on jobs, and so that's not particularly great. The employment is getting worse. If you go and you look at some of the data with respect to shipments, they have been going down. If you talk to a lot of small business owners, you will hear quite a bit of pain in the market on their part. And so a lot of people look at this and say, hang on, alarm bells ringing. We have some sort of a recession coming. And you should probably always be prepared. That's a whole other conversation. But I think what a lot of people are seeing is they're looking at various indicators and they're not really understanding what goes on with the macroeconomy and with specific be prepared markets, in particular financial assets. And as a result, this is causing them to have some confusion. What's going on here? So when I think about macroeconomics, I have a fairly simple model. You essentially want to think about three really important things. One is the supply of money. Supply of money is dictated mostly by the federal government deficit spending, as well as private borrowing. You should think about the volume of assets. If there is more gold that is dug up, there's more assets. If there is, more houses being built, there's more assets, etc. Generally speaking, assets mostly go up, not down. And then the third part is the flows, okay? So what's the environment that we're sitting in today? The environment we're sitting in today is the monetary supply is growing quite a bit. The way it is growing quite a bit is governments are spending big deficits. You have the US with the big beautiful bill. I think it was somewhere around $2.5 trillion deficit spending that they're projecting forward. That's a lot of stimulus. And when governments are putting a tremendous amount of fiscal stimulus into the market, it's very, very difficult for markets to crash and recessions to happen and things like this, right? Now, you can have individual players who can do bad with it, but in the grand overarching view of things, it is difficult to have the market go down dramatically long-term in that environment, okay? Certainly it could happen if you had a lot of different assets coming in, okay? Now we have to pay attention to the other part though, which few people look at, and this is tracking the flows. So the question is always, okay, there's more money going into this, but where is that money going? Who is getting that money? So the first thing to understand is that about $1 trillion a year of that deficit is interest payments on the debt to bondholders. So you're doing this highly stimulative thing to bondholders. Bondholders have a couple really important characteristics. The first is when you're holding bonds, the majority of people who are holding are not going to take that bond interest and pour it into consumption. Typically, it is in retirement accounts, it's in endowment, potentially insurance funds, etc. So that money is almost exclusively going to get rolled into financial assets.